In this video, we are going to be talking all about writing the covered call. Before we dive in to this idea of writing a covered call, I just have to put something out there. There are a lot of option gurus out there trying to sell this idea of trading options like it's a side hustle and that you can act like the casino and just make all this money. Don't waste your time on those things. That's not real. That's not based in reality. What I'm teaching is based in reality. Options are awesome. They're amazing tools to mitigate risk in the market, and you can use them in a variety of ways. But this idea that you can just learn options and then all of a sudden you just rake in all this passive income, it's a lie. It's not true. Yes, options are amazing. Yes, they have boosted my returns, but realize there's always risk reward out there. I'm giving you the truth about options. So what is writing a covered call? Writing a covered call is where you own, let's say, 100 shares of a stock or ETF, and then you agree to sell those shares at a certain price within a certain time horizon, and you are paid immediately for doing that. And that payment is called a premium. So let's dive in.
Okay, this screen should look familiar to you if you watched the video on buying a call option. If you've not watched that video, you need to watch that video before you watch this video. It'll make much more sense. So I'm in my Schwab account. Basically, you click trade options, put in your ticker symbol that you want to look at. We're going to look at the Amazon options, and everything takes place right here to either buy or sell options. When you buy a call option, you click buy to open, and you can see we don't have this on put. That would be buying a put. We have it on call. When you're writing a covered call and you are selling a call option to another investor, you have it on sell to open. We have quantity one. That stands for one contract. Every contract represents 100 underlying shares. So when you write a covered call, you have to own at least 100 shares. If you want to write one covered call, if you want to write 3 covered calls on a stock or ETF, you have to have 300 shares. So we have quantity 1 up there. Here is essentially all the option chains. They call it an option chain. You have all the different expiration dates. Yeah, we could do one for January 30th, 2026, which is like 2 weeks from now. Today's date's January 22nd, 2026. And you could pick all the way out to December 15th, 2028. So you could pick a really long time horizon. So let's review what writing a covered call means and what we're actually doing. We're simply agreeing to sell the shares of what we own, stock or ETF, at a certain price in a certain time horizon. If at the end of the time horizon, the shares are trading above that strike price that we chose, the shares will be sold for that price. Let's first just let's imagine we bought Amazon for $235 a share and then we agreed to sell it for $270 a share come January 15th, 2027. You can see we would immediately collect $2,100. This is referred to as a premium. That money is ours now and forever. So if we would do this trade, let's think about the total profit that we would make if Amazon is in fact trading above $270 come January 15th, 2027. You simply add the premium, $21 per share, to the strike price that you chose, which is $291, and then you subtract it from how much you paid for the shares. Let's just say $235 we paid for the shares. If we did a trade like this and Amazon gets above $270, we stand to make $56 in profit per share times 100 shares. So $5,600 would be the profit on this trade. If we chose a higher strike price, you get less premium. Why? Because there's less of a chance Amazon gets above $290 in this window of time. And then of course, if you pick 300, you'll get even less money. So you can see a pattern here. If you pick a 235 strike, you'll get more money. If you pick a strike price less than what you paid for the shares, this option is already said to be in the money because it's trading at, we'll say, 235, and we're agreeing to sell at 220. So this option already is $15 in the money. And notice we're getting a lot more than $15 per share. If we do this, we're getting about 43 per share times 100 shares. So we're getting $4,300 in premium. So it's very logical when it comes to the premiums. If you pick a shorter time horizon, you get less money. let's go even shorter. You get less money. Why? Because the longer an options agreement is, the more time there is on that agreement, and there's more time value that's actually on the value of the option. Investors pay for time. They pay money to see if their thesis is going to actually play out. So this is very simple, very intuitive. Let's talk about, though, we'll go over a couple examples to figure out what the profit on the trade is. So let's look at the profit on the January 15, 2027 trade and see if we can make sense of it. For this one, we're buying the shares for $235. We're then agreeing to sell them for less than what we paid, $15 per share less. But we're receiving $43 per share in premium. So the way to calculate the profit on this trade is you add the premium you collected to the strike price. So $220 plus the premium collected, that's essentially like what you're selling the shares at, because you're selling them for $220, but you already collected that per share premium. So that equals $263. And then you simply subtract it from what you paid for the shares, which is $234. So this particular covered call has a capped profit. And I say capped because stock could go to 300. We still have to sell for $220, and we collected $43 per share. So for this particular covered call, the cap profit is $2,900. That is $29 per share in profit. Not a lot of money, but notice if you pick lower strike prices, we'll do a 200 strike. Yes, you get more money in premium. That's a bigger premium. You get $55 in premium because you are agreeing to sell it for $200 a share. Again, it's trading at $235. So what's the profit? If we should write this covered call, what would be the total profit? You simply take, let's just say $55. It would be the strike price, 200 plus $55 per share minus what we paid. This one would be $2,000 in profit. So less money than the 220 call. And that's a pattern you're going to see. That's a trend. The deeper strike price you pick, the less profit there is on the trade. Now, why is this? Well, it's because the investor on the other side is taking on more capital risk. They're giving us $5,500 up front. So now we have $5,500, 55 per share in downside protection. So if we would do a trade like this and Amazon drew down $55, and let's say on January 15th, it's trading at $55 less, we'll still have lost no money. So this is a risk mitigated trade where we can generate some safer income. The stock can actually go down a good bit and we can still make our money. So if we did this trade and we picked a 200 strike, and let's just imagine that on January 15th, 2027, Amazon drew down to 200. And we did this trade. We collected $5,500 and Amazon drew down to 200. And so now on expiration Friday, it's trading at 200 a share. We still made our full profit on the trade because we can sell it for 200 and we collected the 55 in premium. So the full profit will still be realized of $2,000. So this is a good trade for people that are retired that want to try to make some safer income because bonds don't pay as much yield. Bonds pay like 3.5%-ish. So this is a way to try to go out into the market, buy a solid company or ETF, and then you write a covered call and you pick a strike price less than what you paid. The deeper strike you pick, the more money you get, but then the less profit that you'll get because there's less time value on the option that we sold. So let's do the numbers on this one. So we're picking a really deep strike price. Buy for $235. Say we're going to sell and agree to sell it for $165. You simply add $82. You have the premium that collected per share, add it to the strike price. So 165 plus 82 is 247. And we'll say minus 235 of what we paid. This particular covered call has $1,200 in potential profit when the trade reaches expiration. So if Amazon is trading above 165 a share, we stand to make $1,200. Not a lot of money. But the reason being is because we're collecting a huge chunk of money up front, which is a lot of downside protection. We're now getting $81 in downside protection. So Amazon could actually, come expiration Friday, draw down $81 and we'll have lost no money. And you can just mess around with different strike prices and see if you pick a really high strike, like maybe a 310 strike, you'll get $1,100. So if you do a trade like this, you stand to make a lot more money because the stock can go up a good ways until you reach the price that you agreed to sell it for. And you still calculate the total profit on the trade by adding $11 per share to 310. We'll just say it's $10. So we'll say $11. So it'd be 310 plus 11, that's 321, and then you subtract the 321 from the 234, and that's the total profit on the trade. So this trade here has a lot more upside potential if you pick a high strike price. But there's a trade-off. Now you have less downside risk mitigation because you're only collecting $11 per share, so $1,100 total. So if the stock would draw down more than $11 a share, you'll have some paper loss. I'm a big proponent of always having downside protection in my portfolio year over year. All over the internet, there are options gurus that recommend this idea of selling monthly covered calls. So we would buy the shares, and let's say we'd pick a 227 expiration, so about a month. And then the idea is you pick a high strike, like say a 280 strike, we'll say 270, and we'll get $151. And the theory is that Amazon will not reach 270 in a month, and this just is all profit. And then guess what? The next month you write another covered call, and you're able to extract income off of a stock, a good stock, hopefully. You should always pick a good stock. And it's just a way to get more income off of your stocks that can even beat what, say, a dividend stock would pay. I did this for a long time. I did it for about 16 months, maybe 18 months, and it just doesn't work. I know it seems like free money when you do this. Like every month you're just going to get $151 off of your favorite company, and your company can still go up and your shares never get called away, and then you can just keep writing covered calls. It sounds good, but I have to tell you it doesn't work. And I'll probably have, it's called portfolio overriding, and I'll probably have a whole video on why it doesn't work. So I actually use options differently, and I do everything long. And the reason why I do long options with long expirations is because I want a bigger chunk of money up front, which means more downside protection. So that is what I do, and I re-up them every year. So I do the long contract periods, and sometimes when I buy a stock, like if it's trading at all-time highs, but I still want to have ownership, I may buy it and pick a strike price less than what I bought it for to collect a bigger chunk of money in case the stock kind of goes down a little bit. I have a little bit of downside protection. That's what I do. If a stock is at all-time lows and is one of my favorite companies, I'll probably pick a high strike price to allow for a lot of upside appreciation. And I typically combined, I really think the sweet spot, I think for options is actually doing spreads, where I'll obviously get to that on my channel as I show all my trades. I'll actually be using puts and calls together on a holding to create a symmetry, but that's kind of down the road. In this video though, I just want you to understand what a covered call is. Now, some people ask, can the stock get called away before expiration if it's trading above the strike price? And the answer is yes. And if that happens, that's actually a good thing, because you can then just go buy the stock on the open market if you want to and just redo the trade. And you didn't have to wait all of that time to realize profit. Another thing I want to say is when you do trades like this, it takes week over week, it takes time for the time value to decay off of the option. So let's say we did the 235 strike and we're essentially getting $3,500. The trade's not profitable yet. We have to wait because we have to hold on to the shares for a year. And over that year time horizon, if Amazon goes up or sideways, the time value is decaying either way, and the trade slowly becomes profitable. You don't have to wait all the way to expiration to realize some healthy profit. And with any options agreement, you can always get out of the agreement at any time. You can get out of the agreement that day. If you want, you'd have to buy back the option you sold, probably for pretty much what you got paid. You can maybe 6-7 months from now, if the trade is going well and it has some profitability, if you see a better opportunity, you can buy to close the covered call and then sell the shares. When you write a covered call and you have it in your account, you are not allowed to sell that stock until it expires. But you can always get out of any options agreements at any given time if you want to. That's where options just get a little more complicated, but again, they're not complicated. To summarize this video, when you write a covered call, you own the shares and you simply are agreeing to sell it at a certain price within a certain time horizon, and you collect a premium. If you choose a longer contract period, you get a bigger chunk of premium, which in my opinion offers more downside protection, because if the stock starts to draw down, you will actually see in your account on a different line the call offsetting your losses. And I'll of course be having that in all my videos as I show actual trades and how they play out. But it's very simple. If you pick a higher strike price, you get less premium, so you have less downside protection, but you have more upside. So it's always that risk reward balance. If you pick a shorter contract period, you'll get less money because there's less time value on the contract. And you probably understand this if you watched the first video. I think covered calls are awesome. I do all long covered calls. I used to do monthly covered calls. It didn't work. And my account has done so much better and my returns have boosted. I would say I can't even compare how much my returns have boosted since learning how to do options and doing them long.
In the next video, we will be talking all about the put option and how I use them to set up asymmetrical trades. I hope to see you there.